Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Tuesday. It's November the 1st. October is behind us. Halloween is behind us. Now we're getting forward towards the big holidays, right? Thanksgiving and Christmas. Folks, where did this year go, right? Anyhow, it's about 8:13. Let's get started. Now, the market's going to open up in about an hour and 17 minutes to be specific with you. And we opened up pretty good yesterday, and we huffed and puffed, and then we took things down. We're opening up again pretty good, this time across the board on the tech and the Dow. One of the reasons why we're opening higher is because earnings are slightly better than expected. So far yesterday, we had a really broad mix of earnings. We're now going pretty broad-based. Today, the big stocks that are reporting are going to be Franklin Resources and Aflac, financial stocks. It'll be very interesting to see how it does. But you also have AMD, semiconductors at 73 cents. And by the way, 46% down year over year, Franklin is expecting. And Aflac, they're expecting negative 21%. So it'll be interesting to see how they beat earnings. But we've got AIG, we've got Caesars, we've got Cheesecake Factory, we've got Chesapeake Energy, we got Cirrus Logic, we got Clorox. We got a lot of stock, Devon Energy, a lot of energy companies, electric arts, medical stocks, storage companies, communication companies. There's Ben, Marathon Petroleum is coming out, McKesson's coming out. We've got a lot of stocks. Mondelez is coming out, Pfizer. So it's going to be a very, very interesting day. And on top of that, we've got the PMI, we've got the ISM, we've got construction spending, and we've got JOLTS. So you really want to keep your eye on volatility, which is now third day, or at least beginning to be below the 200-day moving average. That's very, very significant, because the Dow Jones is now above the 200-day moving average, or at least was. There it is right there. Now, I wouldn't hold my breath. I think this market is grossly overbought, especially the blue chips. I don't think volatility is going to go down that much further, and I don't think these stocks are going to go that much higher. I don't think the Dow is going into a bull market, which is where it would be had it traded, or if it trades above the 200-day moving average and continues moving higher. I don't think we're anywhere near there right now. I think if you look at this downtrend, you will see that it's almost perfectly aligned, and I believe we're going to be bouncing down. I think we're going to be huffing and puffing, tricking a lot of traders into this market, and then eventually coming right back down and deflating this. Now, it may not be the same for all the sectors. If you look at individual sectors, which we will look at right now, not everything is as inflated. Look at energy. It's pretty inflated, but industrial stocks aren't. So I don't think this is going to be broad-based. For example, communication services, I think, are basing out pretty good. I think consumer discretionary is basing out pretty good. So I'm seeing a lot more downside actually in the blue chip stocks, in the Dow stocks, at least technically, than I'm seeing in the speculative stocks. Because look, communication services is already back down to its base. Real estate isn't really doing anything crazy. Consumer discretionary is basing out to the bottom side. Let's see, technology isn't all that inflated, and it's above the previous resistance level. But if you look at energy, it's a little done. Healthcare may be a little overdone. Financials may be a little bit overdone, especially with Fed raising rates. So be cautious with the blue chips. I'm actually a lot more cautious with the blue chips than I am with the broad market right now. When I mean broad market, I mean the S&P 500, the entire 9 yards. The bond market is still holding up pretty good, and I'm very happy about it because, as you know, we've got the Grim Reaper coming out on Thursday and raising rates by another 0.75 of a point. Now, if the bond market stops reacting to that, that'll be amazing, right? This is looking good right now, but we're still far up from our base. Looks like we're creating a new area here, a new consolidation area. And if we consolidate like we did here, that may cause the stock market to stop the bleed, at least for some time. Small caps are still, believe it or not, we are still holding up. Remember when I said we might have bottomed out in May? Haven't really gone much lower than that. I mean, maybe for a day or two, intraday too. I mean, really, look at that. Not a lot of downside here. So I'm expecting a little more upside from small caps, a little more upside from energy, from technology stocks, consumer discretionary. I think most of the downside is priced into those stocks. But I think the Dow now has to come to terms with the fact that financials, healthcare, those type of assets may not be coming out with earnings that are better than expected. That's a major, major factor. Let's talk a little bit about the pre-open and what we can expect today. 3 major indices were weighted down by losses in the technology, basic materials, and the utility sector. The central bank is anticipated to raise rates by 75 basis points tomorrow after they finish their... Actually, wait a minute. Tomorrow. Hold on a second. Yeah, tomorrow. I thought it was Thursday for a minute. Yes, tomorrow. This is what I'm talking... This is why I still read this thing. And it's 91% chance that's priced into the market and 51% chance that a 50 basis point hike in December is coming our way. So this is still very, very, can go either way. But the fact that we're going to have a 0.75 tomorrow is almost a 100% certainty. It's a 91% certainty. And the number hasn't really been going down. Today we've got 3 major reports. We've got the JOLTS job openings that's coming out in a couple of hours. They're expecting to be above 10 million. Last time it was 10.53. Anything over 10 million is okay. Or around 10 million is okay. We're going to be watching the ISM manufacturing, which was at 50.9. They think it's going to be going down to 50 now. So that's one thing that's baked in. And manufacturing PMI, which we're looking at 49.9 compared to 52. So I don't really see a major reason for Dow stocks to be rallying that hard right now. In Europe on Tuesday, Christine Lagarde said that they want to see inflation go back to 2% target. Meanwhile, at the same time, they saw the number advance to 10.7%. They have a lot of work to do with interest rates. A lot. From 10.7 to 2%, that's quite a bit. China closed a little bit higher, rebounding from a 3-year low as weak economic data boasts hope for stimulus, which I think they're going to get, which will also raise the stocks, Chinese stocks trading in the U.S. They've been beaten down quite a bit. Their cakes and manufacturing data showed manufacturing sector contracted for a 3rd consecutive month amid new COVID disruptions. I'm praying to God they don't come to the U.S. And in Japan, we closed at a 1-month high, fueled by gains in electrical machinery, and shipbuilding sectors. That's an interesting one. So in terms of sectors, folks, let me just tell you what's hot and what's not. In terms of sectors, the strength remains in energy and industrial and in healthcare, in these 3. And on the bottom, we are in consumer discretionary, real estate, and communication services. Now, to look at stocks that are doing really, really good, and I'll use the modified, the longer term scan. Longer term, you've got Oxy, Marathon, Energy, Enphase. Unum, I think, is a healthcare stock. Hold on, I think it's an insurance stock. 1 second, let me just check. Let me check. Yeah, insurance stock. So my suggestion to you guys, is to stick with the top stuff. So look at this. You've got some industrial basic materials in here, but mostly energy and healthcare, and a little industrial sprinkled in. I would stick with these stocks right here. I would actually stick right now with defensive stocks like Northrop Grumman, Cardinal Health. I'd give energy just a little bit of a break to cool off. Maybe go to a little industrial stock like CF. Maybe go to UNM. Give the energy stocks a few days to back off because the Dow's a little overbought. I think they're a little overextended. That's why I shorted GE, Six Flags Magic Mountain, Marriott, a couple of other stocks. I think that they're getting a little toppy right now. But at the same time, industrial stocks, healthcare stocks appear to have more to go to the upside. Now, in terms of defensive stocks, in terms of downside, as I mentioned, you've got real estate, you've got consumer discretionary, and you've got, what was the last one? Consumer discretionary, communications, and real estate. And if you look at it, here's communication, Dish Network. No way. Caesars is having earnings, I think, today. I would stay away from it. But look at this. Etsy, CarMax, Seagate, Bath and Body Works, forget about it. Don't pick big stocks like NVIDIA because they can really go against you. But stocks like Expedia, they're not doing really well. Fornado Realty Trust, not really doing well. Stick to these stocks right here. I personally can't stand Dish. I don't like Generac Holdings right now. PayPal's not doing really well. I wouldn't do Adobe, too much of it. Don't do the hardcore momentum stocks. Do stocks that have been really like flattening, like Bed Bath & Beyond, like Etsy, like PayPal, like Stanley Black & Decker, like Dish. Those are the stocks that I would be shorting right now. Now, as I mentioned to you guys, we've got a lot of reports today, and tomorrow we have the Fed. My suggestion, we're going to have a lot of volatility. My suggestion right now is to keep your eye on the bond market. The bond market is going to give us a much, much better indication of everything that's going on right now. That, and we've got a lot of earnings. Don't expect a lot of directional bias in the next few days. Expect a lot of choppiness, a lot of non-direction, and a lot of confusion, because we're right now deep in earnings. And typically during earnings, there's just too much unforeseeability. And remember, you've got PMI manufacturing, FOMC begins today. You've got construction, you've got the JOLT survey, and all of this happening about half an hour after the market's opening. So you've got to be really careful right now. Now, momentum levels in stocks have really went down. We had 400 stocks making 20-day highs yesterday. We are nowhere near there right now. Look at this. We're only at 149 versus 27. So the market's starting to get a lot choppy. I told you after 400 or 500, it peaks out. The fact that we're opening higher today is a strong sign. But again, let's see how we do second half of the session. The market is very squirrely. Don't trust it right now. Let's let the market show its hand. And I'm very concerned about the Dow Jones. Very concerned about the Dow Jones right now being at the 200-day moving average and the RSI being so overbought. So I'm very encouraged by the fact that we're opening strong, but I'm not buying it for a second, and I think we're going to revert back down. I think it's just a matter of a few days till we do, which means I'm expecting some downside for a lot of the blue chip stocks we come and love. Not necessarily going deeper down, but getting back into this range and getting back into the choppiness that we've been seeing from the small caps. Remember, small caps peaked out. They peaked out almost a year, 10, 11 months before the broad market did. February of 2021, we peaked out in January of 2022 on the SPY. So typically, when these stocks start basing and not really moving, and when you see stocks like Shopify basing out, not really going anywhere, going from 176 to 35. We could go a little lower, but honestly, folks, I think we're there. And I think it's just a matter of getting the gyrations in individual sectors and getting the Fed back to the deflationary pressure we've come to love. But we're not there yet, and we still have a couple of months of this mishigas, I call it. Now, folks, so just a reminder, today at 1 p.m. Eastern Time. Yes, 1 p.m. Eastern Time. Jeff Zananeri, he's going live to break down what midterm elections could mean for the markets. I'm going to be watching this. I can't wait to see this. And Jeff has got a really good understanding of global economy and the macro pictures. That's why we have the big picture every Tuesday. That's happening today as well, earlier. Now, he believes this could be a massive catalyst that triggers a shift in a $54 trillion market. $54 trillion market. Jeff wants to make sure every investor is prepared for what's to come, because if not, you could really miss out on a critical opportunity, a real critical opportunity. It doesn't cost a thing to attend. Click the link below, reserve your spot, do it today. 1 p.m. Eastern Time. I'm going to make sure you're there. I'm going to be watching the names. You show up, and I'll be there as well. I can't wait to learn this. And again, Jeff and I are also meeting earlier today for our big picture. I'll see you guys later. Remember, like this video, comment, and give me heads up. Questions will be answered in the Wealth Press YouTube channel. Bye, guys. Take care. Always feel free to email me at support@marketgeeks.com. Have a great day, and be careful out there. I think the Dow's going to turn south on us. Bye.